Hi students, welcome back to Google Classroom of Sri Gokulam Public School, Guruvayur. How are you children? Hope you all are fine over there.
In the previous class, we have discussed about the main classification of sources of funds. Hope you learned that portions. Now you know that from where the businessmen get the required amount of funds to meet the short-term, medium-term and long-term requirements. Each of the sources of funds has unique characteristics which must be properly understood so that the best available sources of raising funds can be identified. So let's discuss various sources of funds along with their advantages and limitations. Today, let's discuss about retained earnings and trade credit. Then, what is retained earnings? Retained earnings denote profits not distributed to owners. That means, like an individual, companies also set aside a part of their profits to meet future requirements of capital. The portion of the profits which is not distributed among the shareholders but is retained and reinvested in business, and it is called retained earnings. Retained earnings is also called plowing back of profits. Retained earnings are internal source of funding because it is generated from within the business organization, and in most of the cases retained earnings are transferred to general reserve, and these reserves can be used to meet long-term financial requirements like purchase of fixed assets, renovation, modernization, etc. And in some cases, this may be transferred to reserves created for specific purpose. Then, let's discuss the main merits of retained earnings. The first one is, retained earnings is a permanent source of funds available to an organization because it represents profit which are not distributed to shareholders. That means, companies distribute a part of the profit as dividend, and the remaining amount is retained in the business in the form of retained earnings. And the next merit is, it does not involve any explicit cost in the form of interest, dividend or flotation cost. That means retained earnings do not put any obligation on a company, as it is neither required to pay interest nor dividend on the funds generated through retained earnings. And the next merit is, as the funds are generated internally, there is a greater degree of operational freedom and flexibility. That means retained earnings are generated from within the business organization, and it do not create any charge on the assets of the company, so that there is a greater degree of operational freedom and flexibility. And the next one is, it enhances the capacity of the business to absorb unexpected losses. It is because retained earnings increase the financial strength of a company, and this strength may be used to grow business as well as for raising funds externally. And at the same time, it also helps to absorb unexpected losses. Besides these, retained earnings also lead to increase in the market price of the equity shares of a company. So these are the main merits of retained earnings. Then let's discuss the main limitations of retained earnings. The first one is, excessive retained earnings may cause dissatisfaction among us, the shareholders. It is because accumulation of profit often lead to low dividend payment by companies. Not only that, the companies may not utilize it for the issue of bonus shares to avoid higher dividend payment. This may create dissatisfaction among the shareholders. And the next limitation is that retained earnings is an uncertain source of funds, as the profit of the business are fluctuating. That means this method of financing is possible only when the company earns huge profits, and that too for many years. And the next limitation is, the opportunity cost associated with these funds is not recognized by many firms. This may lead to suboptimal use of the funds. Besides these, retained earnings also encourages management to be less careful with the utilization of funds, which may lead to low profitability. So these are the main limitations of retained earnings. Then let's discuss another source of funds, that is trade credit. Trade credit is the credit extended by one trader to another for the purchase of goods and services. And it also facilitates the purchase of supplies without immediate payment. That means it helps to promote the sales of an organization. Trade credit appears in the records of the buyer of the goods as sundry creditors or accounts payable, and it is a short-term source of financing. The volume and period of credit extended depend on factors such as reputation of the purchasing firm, financial position of the seller, volume of purchases, past record of payment, and degree of competition in the market. Then let's discuss the main merits of trade credit. The first merit is trade credit is a convenient and continuous source of funds. It is because the operation of trade credit method is very simple. It requires just an understanding with seller of items required by a buyer who wants to avail trade credit. And the next merit is trade credit may be readily available in case the credit worthiness of the customers is known to the seller. That means generally trade credit is available only to credible buyers. This credibility is generally established through frequent transactions between seller and buyer. And the next merit is trade credit needs to promote the sales of an organization. It is because it facilitates the purchase of supplies without immediate payment. And the next merit is if an organization wants to increase its inventory level in order to meet expected rise in the sales volume in the near future, it may use trade credit to finance the same. It is because trade credit is available without any interest, and the interest is charged only in the case of delay in payment. And the last merit is it does not create any charge on the assets of the firm while providing funds. That means it is a very flexible source of finance. The amount of trade credit may be adjusted according to the need of the buyer. So these are the main merits of trade credit. Then let's discuss the main limitations of trade credit. The first one is availability of easy and flexible trade credit facilities may induce a firm to indulge in overtrading, which may add to the risk of the firm. That means the operation of trade credit method is simple and flexible also, and it leads the business organization to indulge in overtrading, and it also increases the risk of the business organization. And the next limitation is that only limited amount of funds can be generated through trade credit, and it is generally a costly source of funds as compared to most other sources of raising money. And in many cases, sellers charge higher price for items which are sold on credit basis. So these are the main limitations of trade credit.
So students, I hope all of you understood the concept clearly. And please note that the notes of the lesson and test paper are also attached along with the class. Make use of these available materials. Study well and attend the test paper without fail. That's all for today. Thank you.